the subcategory of the general business credit, now we're going to look at the various credits for just individuals not related to business. So there's the earned income credit, and this credit is it's a income tax equity for the working poor. So it's trying to help the working poor get this additional tax benefit and offset their obligation. It also helps to offset flat taxes, such as the gasoline tax, which puts a larger tax burden on the poor. So we've talked about in previous classes, like it's really not fair, because these low income individuals, when you look at the tax that they pay as a percentage of their whole, they're paying much more tax for gasoline than the rich or a higher income family. So this earned income credit kind of helps offset that, because it's giving money back to those low income households. And it also encourages economically disadvantaged individuals to be active working members of the workforce, because it's giving them a credit for their earned income. But if they don't have earned income, they can't get anything for that. So it's trying to help encourage people, even if they're not going to make a lot of money, to get out there and be a part of the workforce, rather than choosing not to work and trying to just, like, as we hear it referred to, like, we're living off the system. It's encouraging them to do less of that and more of an effort to get out into the workforce. So it's determined by multiplying a maximum amount of earned income by the appropriate credit percentage. It includes employee compensation and net earnings from self-employment, but it doesn't include things like investment income. In 2022, the maximum earned income credit for a taxpayer with one qualifying child is $3,733. With 2 children is $6,164, and with 3 or more children is $6,935. And so it's breaking down for you on the side here these maximum amounts by the appropriate credit percentage. But there's tables that the IRS provides to make the calculation of these credits very simple. So for 2022, the credit is the applicable percentage rate times earned income. The rate and maximum amount of earned income is determined by the number of qualifying children. So if you have 0 children, you still might be eligible, but the amount is a lot less. And then when you have more children, the amount is more and more. And after 3 children, it doesn't matter. It's the same amount for 3 or more children. There is a phase out that begins when adjusted gross income is $26,260 for married filing jointly, or $20,130 for other taxpayers. So when we said this is like designed for the working poor, that really, I mean, like, a household income of $26,000 for a married couple with a child is so low, especially in, like, the cost of living that we're seeing today. So it's giving those people a I don't know, I guess just a tax break and kind of a extra little encouragement. As I just mentioned, there is an IRS table to calculate the exact credit amount. It also is available to taxpayers with no children, as I mentioned. But it's only available to taxpayers that are 25 through 64 and cannot be claimed as a dependent on another taxpayer's return. For 2021, the minimum age to claim the credit was reduced to 19, except for full-time students, and the maximum age was eliminated. In 2022, the credit amount for the married couple filing jointly with no qualifying children is 7.65% of earned income up to $7,320. And so again, we're talking about very low income. Like, even if you're married with no kids, annual income of $7,320 is practically nothing. The credit begins to phase out when earned income exceeds $15,000 for married taxpayers filing jointly, or $9,160 for the other filing statuses. There's also a foreign tax credit, which is to try to help minimize double taxation for individuals or corporations that are paying taxes, paying foreign income tax, because they're also subject to income tax in the U.S. And so it gives them a chance to claim a credit on the taxes that they paid in that foreign country. Or alternatively, they can claim a deduction instead of a credit. As we discussed at the beginning of these videos, in most cases that doesn't make sense, but there are some scenarios where that will make sense. So typically the credit is advantageous more so than the deduction because it provides a direct offset against the tax liability. It's designed to mitigate double taxation because, let's just say somebody worked internationally and they paid 20% income tax in wherever, the UK, and then but in the US they would have been subject to 25% tax. Then when in the US, when they file their taxes, they get a credit for the 20% that they already paid. So then they only have to pay that difference of the 5% that they would have owed if all of the money had been earned in the US. It is subject to an overall limitation. So there are instances where there might be double taxation. So the foreign tax credit allowed is the lesser of the foreign taxes paid, or the overall limitation computed as the foreign source taxable income divided by the worldwide taxable income times the U.S. tax before the credit. And unused foreign tax credit can be carried back 1 year and forward 10 years. So kind of like we talked about with the general business credit. An amended return can be filed to go back 1 year, and then it can be carried forward the 10 years. Only income tax, war profit tax, and excess profits tax, or taxes paid in lieu of such taxes, qualify for the credit. Whereas VAT, value-added taxes, severance taxes, property taxes, and sales taxes do not qualify for the foreign tax credit because they are not taxes on income. So, for example, if you lived in the UK for a portion of the year and worked in the UK, you can't track all of your sales tax and include that as tax that you paid because you would have paid sales tax no matter where you were. The sales tax wasn't a tax on your income, and that's what we're dealing with as income tax. For child and dependent tax credit, there's a child tax credit and a dependent tax credit provided to individual taxpayers based on the number of qualifying children and dependents. And so this is just like a family-friendly provision in the federal income tax law. So kind of our way of saying somebody, we could look in the 22% tax bracket, and there could be a married couple with no kids and a married couple with 2 kids, and the financial burden of those 2 households that have the same income, let's just say they both have a household income of $80,000, the household that has the 2 kids has a larger financial burden but is living on the same income as the couple without kids. And so these tax credits kind of help offset that difference. Eligible children have to be under the age of 17. It was changed to 18 in 2021 because of COVID. They have to be a U.S. citizen, and they have to be a dependent of the taxpayer. It's $2,000 per child. The child tax credit is $2,000 per child, and the dependent tax credit is $500 per non-child dependent. The credit phases out as AGI exceeds $400,000 for MFJ or $200,000 for the other tax statuses. And the credits are phased out by $50 for each $1,000 or fraction thereof of AGI above that ceiling amount of $400,000. Because of COVID, Congress had a temporary increase in the child tax credit. So for 2021, it was increased to $3,000 or $3,600 for a child under the age of 6 at the end of the tax year. And the child tax credit in excess of $2,000, or $1,600 per child for age 6 and $1,000 for 6 and older, was subject to its own phase-out rule. And that additional child tax credit as a result of COVID was actually issued to taxpayers during the year, which is very uncommon. Usually it's only refundable at the end of the year, but it was issued starting in, I think, July of 2021, every month through the end of the year. And taxpayers had the option to elect to not receive it early and then receive all of it when they issued their tax return. But people that didn't elect to do that, then if they ended up like being in this phase out rule, but they didn't realize that they were going to be in it, then they actually had to refund the money. And I actually know some people that happened to. Additional tax credit is phased out as AGI exceeds $150,000 for MFJ, so that the amount above the $2,000, the $1,600, the phase out is $150,000 rather than the $400,000. And similarly, it's reduced by $50 for each $1,000 above the threshold. However, this phase out that we're talking about does not reduce the $2,000 child tax credit amount, which has that other rule that we just talked about, the $400,000. In 2021, the child tax credit was fully refundable. And in 2022, it's partially refundable up to $1,500 per child, but no more than 15% of earned income, in excess of $2,500. The dependent tax credit is not refundable. So the child tax credit is refundable. The $500 for a dependent is not refundable. There's also a credit for child and dependent care expenses. And so in general, we have some qualifications. There must be employment-related care costs for a dependent under the age of 13, or dependent or spouse who's physically or mentally incapacitated and lives with the taxpayer for more than 1/2 of the year. So what we're saying is you can get a credit, or I guess what like Congress is trying to encourage is creating an opportunity where people that have dependents that need their care, that they still have an opportunity to go work rather than feeling like they have to stay at home to care for those people, because it helps offset the cost of the child care that they have to pay for, which makes working more achievable. And so, for example, like my husband and I looked at child care, and it would cost us like $24,000 a year to have both of our children in child care, only 3 days a week. And so it's kind of crazy when you think about that, because it's like, well, you know, like if my husband was going to change jobs, which would require us to spend another $24,000, he has to make more than an additional $24,000 for that to even make sense. But this child tax care or child care expense credit helps offset some of that. As far as the physically or mentally incapacitated, it provides that same opportunity for people that don't have necessarily a child under the age of 13 or a dependent, but a dependent that still requires their care because of their physical or mental incapacitation. It's a specified percentage of child and dependent care expenses, and it's capped at a maximum of $6,000. And married taxpayers have to file joint to get the credit. So if you're married filing separately, you're not eligible for the child and dependent care expense credit. Eligible employment-related expenses would include the amounts paid for household services and care of a qualifying individual. It can be provided in the home or outside of the home. If it's outside of the home, physically or mentally incapacitated dependent must spend at least 8 hours a day within the taxpayer's home. And so this clause is trying to avoid somebody that just chooses to like hospitalize the, or maybe hospitalize isn't the right word, but institutionalize, I'm not sure, the dependent and then still claim the credit. So you can't put them in a service all the time and still claim this credit. It has to seriously be that you are putting them there so that you can work. And as I was saying, this credit, it makes the credit available to taxpayers who are keeping handicapped older children and relatives who are 65 and older in the home instead of institutionalizing them. And child care payments to a relative are eligible for the credit unless the relative is a child under the age of 19 of the taxpayer. So you can't like pay your oldest child to babysit your youngest children and still get the credit. But if you like pay your mom, let's just say, child care expenses, then it still counts. There is an earned income ceiling, so qualifying employment-related expenses are limited to an individual's earned income. So you can't try to like have expenses of $60,000 and only have earned income of $24,000. For married taxpayers, it applies to the spouse with the lesser amount of earned income. And so if you think about like that making sense, like I was kind of saying with my husband and I looking at childcare being $24,000 a year, the limit is the lesser of either of our incomes, and that makes sense because it's kind of like if it was more than that, then the other person should just stay home with the kids rather than working. There are special rules for taxpayers with non-working spouses who are disabled or full-time students. So a non-working spouse is deemed to have earned income of $250 per month if there's one qualifying individual in the household, or $500 per month if there's two or more individuals in the household. So to calculate the credit, there was changes because of COVID. So because there was an increased need for child and dependent care during COVID because so many kids weren't in school, Congress increased the amount of expenses and the credit rate and changed the income eligibility rules for 2021. But in 2022, these items have returned to their previous levels. The credit is equal to a percentage of unreimbursed employment-related expenses, up to $3,000 for one qualifying individual, $6,000 for two or more individuals, and it starts at 35% and decreases to 20% as AGI increases. There's two education tax credits that we need to look at, the American Opportunity Credit and the Lifetime Learning Credit. They're both available for qualifying tuition and related expenses. Books and other course materials are eligible for the American Opportunity Credit, but not the Lifetime Learning. And room and board are not eligible for either of the credits. The American Opportunity Credit per eligible student is a maximum of $2,500 per year for the first 4 years of post-secondary education, 100% of the first $2,000 of tuition expenses, plus 25% of the next $2,000 of tuition expenses. The Lifetime Learning Credit is a maximum of 20% of qualifying expenses, up to $10,000 per year, and it cannot be claimed in the same year that the American Opportunity Credit is claimed. So for a lot of people, the American Opportunity Credit makes more sense for their first degree, like their first bachelor degree, whereas the Lifetime Learning Credit makes more sense for like going back for your master's degree or additional education after that. However, there are instances where people end up using the Lifetime Learning Credit earlier on and electing to use that rather than the American Opportunity Credit. To be eligible for the education tax credits, it includes the taxpayer's spouse, and the taxpayer's dependents. For the American Opportunity Credit, the student must take at least 1/2 of the full-time course load for at least one academic term at a qualifying academic institution, but there's not a requirement for the Lifetime Learning Credit. So like I said, the American Opportunity Credit usually makes more sense for your first degree because typically you will be enrolled in a half-time capacity at least. Whereas if you're going back to school later on, like doing your master's degree, you might be taking one class at a time at night or something like that. And so you would only be eligible for the Lifetime Learning. There are limitations, income limitations, and refundability considerations to think about. So both of the credits have income limitations. The American Opportunity Credit is phased out beginning when the taxpayer's modified AGI reaches 80,000 or 160 for MFJ, and it's completely eliminated when AGI reaches 90,000 or 180,000 for married tax payers or MFJ. In addition, 40% of the American Opportunity Credit is refundable, and the entire credit allowed may be used to offset the taxpayer's AMT, alternative minimum tax liability. The Lifetime Learning Credit is not refundable, and it is not able to reduce the AMT liability. There's energy credits to encourage people to be more energy efficient. So tax credits for installing energy efficient windows, insulation, heating and cooling equipment, purchasing solar or other energy efficient water heaters, and installing equipment in a business to produce electricity using solar, wind, or geothermal sources. There's also a credit for certain retirement plans, which is to help encourage more low and middle income taxpayers to contribute to qualified retirement plans. And so the rate depends on the AGI and filing status. It's a maximum credit of $1,000. And to qualify, you must be at least 18 years and not a dependent of another taxpayer or a full-time student.